March 2026. A narrow stretch of water, one of the most important in the world, suddenly becomes a pressure point for the entire global economy. Amid rising tensions with the United States, Iran moves to effectively block the Strait of Hormuz, a passage that carries nearly 20% of the world's oil and liquefied natural gas. Then, the situation escalates. On March 26th, Iranian media reports that lawmakers are considering a new policy. Ships passing through this critical route may soon have to pay a toll, not in US dollars, but in Chinese yuan. Now, this isn't coming out of nowhere. Iran has been settling oil trades with China in yuan for years, and across Asia, the use of RMB in energy transactions has been quietly growing. Individually, these changes seem small, but together they raise a bigger question. Is the Petroyuan becoming a real challenge to the petrodollar? Let's take a closer look. First, we need to understand where the yuan actually stands today. According to SWIFT data as of 2026, the yuan is still a second-tier global payment currency. It ranks behind the US dollar, euro, British pound, Japanese yen, and even the Canadian dollar. Right now, it accounts for only about 2.7% of global payments through SWIFT. Interestingly, that number was actually higher before. The yuan peaked around 2024 at roughly 4.5% and has declined since then. But that doesn't mean it's losing relevance. Part of the reason is structural. More than 25% of China's cross-border trade is now settled through CIPS, China's own payment system, which bypasses SWIFT entirely. So the yuan isn't just growing within the system, it's also building a system of its own. Now, let's look at where the yuan is gaining real traction: oil. The share of global oil transactions settled in yuan, often called the Petroyuan, has risen from nearly 0 in 2020 to around 3 to 5% today. That may still sound small, but in global energy markets, that's a meaningful shift. And it's not happening randomly. Most of this growth is concentrated in trade between China and countries like Russia, Iran, Venezuela, and even parts of the Middle East. Countries that either want to reduce reliance on the dollar or simply do more business with China. At the same time, China is building pricing power. The Shanghai International Energy Exchange, where oil is traded in yuan, now accounts for a growing share of global futures activity. But here's the key point. The Petroyuan is not a dollar killer, at least not today. It's better understood as a sanction shield. For some countries, using yuan isn't about replacing the dollar, it's about flexibility. Take Saudi Arabia, for example. They sell significantly more oil to China than to the US. So settling part of that trade in yuan isn't political, it's practical. Now step back and look at the bigger picture. Despite all these shifts, the dollar remains incredibly dominant. And the reason is simple. Global capital still flows into the United States. US equity markets alone make up nearly 50% of total global market capitalization. That's a massive concentration of capital, liquidity, and opportunity. And it's not just about size, it's about quality. Companies like the Magnificent Seven generate revenues comparable to entire economies like Germany. That's why many investors say stocks are the new bonds. Even during geopolitical stress, like the recent Middle East tensions, capital didn't rotate heavily into yuan or even gold. Instead, it flowed into US equities. And perhaps the most telling signal, investors were selling gold and buying dollars. So what about the future? There are two major trends to watch. First, the yuan will likely continue to internationalize, but slowly. China still maintains capital controls, and much of yuan trading happens offshore, especially through Hong Kong. These constraints limit how quickly it can evolve into a true global reserve currency. Second, the US faces long-term fiscal pressure. Its growing deficits raise valid concerns about debt sustainability. As Ray Dalio has pointed out, history shows that excessive debt can eventually lead to currency devaluation or broader monetary shifts. But these transitions don't happen overnight. The US still leads in capital markets, technology, and military strength, and the resilience of its economy continues to support the dollar's global role. So instead of a sudden replacement, what we're likely to see is coexistence, a gradually rising yuan alongside a still dominant dollar. And there's one more force that could change everything: artificial intelligence. If AI truly becomes the next industrial revolution, driving massive productivity gains, then leadership in AI won't just be about technology. It will define the next era of global power. So how does all of this impact your portfolio? It comes down to one word: diversification. Not just across asset classes, but across geographies. U.S. equities should still be a core holding, but relying on a single market in a shifting global system carries risk. One sector to watch closely is energy. As AI and advanced computing scale, they require enormous amounts of power, and that makes energy both a constraint and an opportunity. For now, energy remains expensive and strategically critical. Over time, breakthroughs like quantum computing could reshape this dynamic, but that's a story for another day.